Fed moves, inflation concerns, and the outlook for growth. India's central bank governor sits down for the CNBC Conversation. Hello and welcome to the show. I'm Tanvir Gill, and on this episode, I talk exclusively with Shaktikanta, the governor of the Reserve Bank of India. And just on a programming note, this interview was filmed just before the US Federal Reserve's interest rate decision. Governor, thank you very much for joining us on CNBC. I do want to start off by asking you that with a lot of DM central banks now embarking on a rate easing cycle, what does this mean for emerging market central bank policy direction?
I was anticipating this as the first question because I think this seems to be the rate cut season. But on a serious note, you see, our monetary policy will be governed primarily, I would like to stress, primarily by our domestic macroeconomic conditions, by our domestic inflation growth dynamics and the outlook. So we are governed by that. Yes, of course, what is happening around us, what the Fed does or what ECB does or what some of the other central banks they do, it does impact us and we do look at that. But eventually in the ultimate analysis, our decision is driven by domestic factors, how the inflation scenario is playing out, what is the outlook, how the growth conditions are playing out and what is the outlook. So therefore, our decision will be based primarily on domestic considerations.
Within that context, Governor, how is the RBI thinking about rate cuts?
Well, at the moment, obviously, we have maintained status quo in our rate cycle so far. After our rates, we increased it up to 6.5. After that, for the last 2 years or so, we have maintained status quo with regard to the rates and with regard to the monetary policy stance. The latest inflation print for August has come out yesterday. So next monetary policy meeting will be held in first week of October. So the monetary policy committee will take a decision. But having said that, let me say that we have to really see how the outlook is. It's not a question of that in the in the current context. In July, the inflation came to about 3.6. That is the revised number now. Yeah, 3.6, and August has come at 3.7. So it's not so much how the inflation is now. We have to look at for the next 6 months, for the next 1 year, what is the outlook on inflation. So therefore, I would like to sort of step back and look at more carefully what is the future trajectory of inflation and growth, and based on that we will take a decision.
And we'll talk about inflation outlook and growth outlook for the long term, but I do want to understand from you, as we speak, is the MPC at the RBI actively considering a rate cut, and will that happen in the October meeting?
No, I can't say that. First, in October we have a new MPC in the sense that the external members will be new because the current external members, their tenure has ended. So there will be new members, external members, 3 members who will be inducted into the MPC. So we will discuss and decide in the MPC. But so far as growth inflation dynamics is concerned, 2 things I would like to say. One, the growth momentum continues to be good. India's growth story is intact. And so far as the inflation outlook is concerned, we have to look at the momentum, the month-on-month momentum, and what is the momentum of inflation, build up or moderation, either way. So what is the momentum of inflation trajectory in the coming months? So the outlook we have to look at. It has to be a forward-looking approach. So based on that, we will take a decision.
Many analysts and economists believe that the RBI doesn't give forward guidance on rate cuts or policy direction, decisions. And so I wonder, why does the RBI not do that? So why don't you prepare the markets ahead of time on a policy pivot?
It can be very risky because it applies both ways. So if you give forward guidance, sometimes, given the uncertainty that surrounds us in the world, and today it's a fast changing world, geopolitical events are happening with suddenness which we have not seen before. Climate related developments, weather related developments are also coming with the kind of suddenness which we have not seen before. So with so much uncertainty, and the monetary policy between the countries are now also diverging. Growth scenarios are also diverging. So it's so much of uncertainty around us. If you give a forward guidance, you will be sort of leading the market in one direction, and if something happens the other way, something goes wrong, and you will not be able to keep up to your forward guidance. Then you would have unnecessarily, without any outcome, without any consequence, without any positive impact for anyone, you would have probably encouraged the market to board the wrong bus or the wrong train. So you would have directed the market in one particular direction. So therefore, we do not give forward guidance in terms of when I am going to increase the rate, how much we will increase. We don't give forward guidance in that manner. But we do give forward guidance because we always give our inflation projections, our growth projections for the current year, and as we move forward, to begin with the first quarter of the next financial year and then take it to the next quarter. So in terms of growth numbers, quarter to quarter, and in terms of inflation numbers, we are giving the figures. So to that extent, RBI gives forward guidance. But yes, we have our reasons, as I explained, not to give, not to be so explicit to say that we are going to increase or not increase, that we will go for this, 25 or 50. I think that can sometimes be counterproductive.
And I understand that. I appreciate that. I have empathy with that view. You said recently the last mile on disinflation is yet to be covered. With a good monsoon, with oil prices coming down, do you think that last mile risk is reduced? And how would you qualify last mile? So I understand you cannot give forward guidance as to when you're going to cut in October, December or March. That's what economists are projecting or expecting. That would be the period within which you would start your rate easing cycle. But would want to get a sense of whether you're closer to that point in terms of thinking about starting to cut rates. And how long does this last mile last? Months or quarters?
No, last mile is the last mile. 1 mile cannot become 2 miles. But on a serious note, the target is 4%. I have said it earlier. MPC has also said it earlier. The target is 4%. We have to be at 4% or be around 4% on a durable basis. To the extent that it should give us confidence that yes, it will remain around 4% for some time. It cannot be some sudden dip in inflation and then you start celebrating and then you find that after 2 or 3 months again the inflation has gone up. The decision has to be taken in a very careful and calibrated manner. Because if I can draw the analogy, like there is that saying that if you open the gates, the horses will bolt. If you treat inflation as a horse, if you open the gate, we have to see what is the speed at which the horse is going to bolt. Because if the horse suddenly, that is the inflation horse suddenly gathers momentum, then you will become helpless. So we have to hold inflation in a tight leash.
But inflation has been coming down.
No, so coming more specifically, without going into all this analogy, we have to be convinced that inflation is now here going to stay around 4% on a durable basis.
And what would be the nature of the cycle, the rate easing cycle, once you embark on it?
Again, that is difficult to say.
Data dependent.
It will depend on how the situation plays out. But we would not like the cycles to become too short. You see, it cannot be that you start cutting the rates and again after 6 months you have to increase the rates. Of course, the counter argument can be that you can be very nimble and you can always respond to that. But it's not good for the markets. It's not good for market. It's not good for investment because stability in the interest rate regime. That is why the concept of price stability has been evolved. When you ensure price stability, you are adding to the stability of the markets, you are adding to the stability of your investment climate and your economy.
So I'll make one more attempt at this rate cutting question on when you're going to cut rates. Economists are divided between October, December and March. Before the closeout of FY25, are you going to cut rates?
No, this question is like a ball which is outside the off stump, so I will leave it.
Okay,
not take the shot.
Still ahead, policy priorities and the rupee. When can we see the Indian rupee getting internationalized? The CNBC Conversation will be right back. Welcome back to this special CNBC Conversation with India's Central Bank Governor Shaktikanta Das. What is your policy priority right now, Governor?
Policy priority is to ensure price stability. You are talking about overall policy of the RBI.
Yeah.
To ensure price stability in terms of keeping inflation at around 4% on a durable basis. Number 2 is financial stability. That is one area where I think the Reserve Bank has succeeded considerably, because the health of the banks, the NBFCs and the entire financial sector in India is very stable and very healthy now. And third, we see a big opportunity in India with regard to fintech innovation, with regard to use of fintech in the financial markets. So the third priority is to support fintech innovations, to support imbibing of fintech and innovation into the financial services sector.
And what about managing, like you said, the objective between inflation, growth and Forex movement?
Things have worked out in India quite well. The exchange rate of the rupee has been one of the least volatile in the recent 2 years or so. In fact, if I should say from beginning of 2023 till now, I think rupee has been very stable vis-a-vis the US dollar. And the volatility index, if you look at the volatility index, rupee is the least volatile.
So some Forex traders, in fact, have asked me to ask you this question on their behalf. Why hasn't the RBI allowed currency volatility?
No, if you allow volatility, whom does it benefit? It doesn't benefit the economy. So why would we allow volatility? You see, it's like this. We do not like excess volatility. But fluctuations in the exchange rate does happen. Our stated policy is to prevent excessive volatility of the rupee, of our exchange rate. And that is something which is, our policy. The situation in India today, which many people miss out, is with regard to the Indian rupee and its exchange rate. A point which is missed out quite often is that Indian economy, our macroeconomic conditions, our financial stability conditions, India is, are much more, the fundamentals are much stronger than they were a few years ago. So when the macroeconomic fundamentals are so strong, when the financial sector fundamentals are so strong, naturally the rupee will gain strength. That is the function of the market. We are not artificially keeping it strong. People probably expect rupee should depreciate more. But the point is, you are not looking at the fact that Indian economy has become much stronger today. Second thing is, today India is attracting also a lot of foreign Forex inflows, especially after the bond index, inclusion of India in the bond indices, and India turning out to be a, very sound and safe investment destination. The inflows are quite strong. What we try to do is to prevent excessive volatility and maintain a orderly depreciation or a orderly appreciation. So overall stability of the currency gives lot of confidence to the markets, give lot of confidence to the importers, to the exporters, to the investors. Because as frequent volatility will means that everybody will be sitting on the fence and watching when to step in. That cannot be an accepted situation for a large economy like India.
Sure, sir. Forex reserves in India nearly reached $700 billion. What is the thinking out here in terms of beefing up Forex reserves? How are you thinking about it? Do you want to cross the $1 trillion mark in Forex reserves? And if so, the fact that you are looking at building stronger Forex reserves makes me wonder whether you are concerned about external shocks going forward.
You see, today I think every economy, every central bank, especially in emerging market economies, have to create their own buffers. There is no global safety net which is available to you at a short term, which you can sort of take recourse to quickly. And secondly, for a large economy like India, we have to build our own safety nets. We cannot depend on external agencies or any other country or any other multilateral organization. Indian economy today is the 5th largest economy with aspirations to become the 3rd largest economy, which it will, according to projections given by various international agencies. Now, a large economy like India, if it has to grow, and it will grow, I am sure, we have to have our own buffers. So therefore, we have no specific target about our reserves, whether it should be 1 trillion or 800 billion or no such target, but every opportunity of building of Forex reserves we will utilize, because that helps, that gives lot of solidity to the economy. This time around, after the Ukraine war, when the outflow of dollars happened in almost every emerging market economy, the pressure on the Indian rupee was much less than what India witnessed during the taper tantrum. But this time around, after the Ukraine war and when the advanced economies started tightening their interest rates, when they started increasing their interest rates, we did not see that kind of outflow which had happened earlier, because the investors in India, the external investors, the foreign investors in India were confident that India will be able to meet its external payment obligations. So therefore, building up a buffer is good for a large economy like India. It will be a, it will provide the required support to the economy. It will bring in stability and allow the economy to grow.
One of RBI's aspirational goals, sir, is capital account liberalization of the currency and internationalization of the Indian rupee. And I wonder how you're thinking about it from a timeline perspective. When can we see the Indian rupee getting internationalized?
You see, the capital account convertibility, it's a process. We don't have a target that by this date we want to make our currency fully convertible.
Doesn't it seem like the need of the hour at a time when there's so much talk about non-dollar trade?
No, we are not ready for capital account convertibility at the moment. It's a process. We have done considerable amount of liberalization. Only one or two big things which are pending is that we have not yet allowed, our Indian citizens to open accounts in foreign banks, and like that some 2-3 things are pending. Other than that, it is already whatever all elements of convertibility are there. Now, with regard to the other aspect of your question, that is internationalization of the Indian rupee, yes, we have come out with a strategy for internationalization of the Indian rupee. We have opened this facility of creating a rupee Vostro account, whereby rupee denominated international trade between India and other countries can happen, rupee denominated. We have also signed local currency trade agreements with UAE. That is the first country with which we have signed this agreement. So we are already in discussion with a few other countries in our region, in Southeast Asia, in the Middle East Asia, and to sort of promote more of local currency settlement, to promote more of rupee denominated trade settlements, so that the whole idea is to reduce the risk involved in all the trade being dependent on only one currency. When you have more than one currency used for settling payments for international trade, to that extent you are de-risking your trade.
Up next, India's growth prospects.
I think overall India's growth story will be intact for the years to come.
Welcome back to the CNBC Conversation with the Reserve Bank of India's governor. We've discussed rates, inflation and Forex. So now it's time to turn to India's economy. I do want to talk about growth projections, because you're talking about a 7.2% growth for FY25. And the Q1 number came in at 6.7%. Is there downside risk to growth?
No, not at all. The first quarter growth of 6.7%, if you disaggregate the data, you will find that consumption is 7% plus, I think 7.4% or so. Compared to the previous years, this first quarter, it was around 4.5% or so. So consumption has picked up. Consumption, investment, industries, services, all sectors are growing at more than 7%. Agriculture, the growth was about 2.2% or so in the first quarter, but we were going into the monsoon. There was slightly delayed start of the monsoon. Monsoon has been very good. Agriculture will pick up. Construction sector has recorded a growth of 10% plus. Yeah. So therefore, all segments, all components of GDP growth are, the momentum is very strong. The only element, the only component which slowed down was government expenditure, both state, central government expenditure as well as expenditure of the state governments, perhaps due to the fact that that was the election season in India. So going forward, I would expect the budgeted amounts will be spent by the central and the state governments, and then they will be able to catch up. So we are quite confident about the 7.2% growth which we have projected in our current year's assessment. And interestingly, international agencies like the IMF and the World Bank, which had earlier projected, they have upgraded. They are all at 7%.
That's right.
And they have done it recently.
Yes.
World Bank done it about less than a month ago.
That's true.
IMF did it about just about a month ago or so. So they have now increased it to 7%, and we have given 7.2. So we are reasonably confident that the 7.2% growth will be achieved this year, because the underlying momentum is very strong and is not driven by some seasonal factors or some one-off factors. The growth momentum in India is very strong, and it is primarily attributable to structural factors. It is mainly the structural reasons which are driving growth, and in that I would like to include the growth in the infrastructure, physical infrastructure, the roads and the other network, growth in digitalization, growth in the fintech space, or for that matter, let me talk about the investment climate. Government capex has been strong, continues to be strong. There are clear signs of private capex picking up now. It has happened in a few sectors already, and our interaction and with the banks and our survey of industries shows the investment intentions on the part of the private sector are also very strong. So these are structural drivers, these are very solid drivers, which I think gives me the confidence to say that this year we will achieve 7.2%, and I think overall India's growth story will be intact for for the years to come.
For the years to come, because for India being the world's fastest growing major economy, everybody outside of India is thinking about what the long-term growth trajectory of India would look like. You said India's long-term potential is 7.5% or more. I wanted to understand that a little bit more from you, Governor, because China at its peak was going at a run rate of 10% for many years. What is a sustainable, healthy, consistent growth rate for India over the next 5 to 10 years, let's say?
You see, difficult to say at this moment. 10 years, I will not like to venture into that. But I think in the medium term or in the next few years, India's growth rate, as I said, it's 7.5% with upside possibilities. Some more reforms which I think one expects them to be undertaken, and I think that is already a work in progress. And I said 7.5% earlier today on a conservative basis as India's potential growth. So I think a 7.5 to 8% growth will not pose sustainability concerns. I think it can be sustainable. But if you are looking at 10 plus growth, that one has to really, before I venture into that, I have to really do my homework much more. Today, based on the fact,
8% job creation would be adequate.
It should. I mean, it should. Job creation has been happening. It's not as if jobs are not being created. Again, that is one big debate. I don't want to enter into that now. And but today, 7.5% is potential growth. It is a sustainable growth. It can be between 7.5 to 8%, I would like to say, but on a conservative basis, 7.5.
Okay, fair enough. Governor, you have been rated as the world's best central bank governor, second year in a row. So it's only fair that I end this interview by asking you whether that makes the case for a term extension in December, your term extension in December.
Well, how can I talk about that? I mean, I'm not the deciding person.
I'm hearing 1 year is already in the bag.
No. I'm not. First thing is, I am not deciding. I don't take such decisions. And second thing is, you see, it doesn't really concern me. If
but from policy continuity perspective,
that is, you see, so far as I am concerned, two things are important. One, RBI has got institutional continuity. Irrespective of who comes as governor, who goes, RBI as an institution maintains continuity in terms of policy, in terms of its whatever it is doing, in maintaining financial stability, in maintaining continuity of policy, in supporting economic growth of the country. RBI is an ongoing institution. There will be institutional continuity. So it is the institution which is more important than the individual. Second thing is, as far as the individual, that is, I am concerned, I am currently focused on my current work. I am not so much worried about what will happen after 3 months. Heavens will not fall in the absence of any individual. The world will continue, RBI as an institution will continue, and will continue to do well, irrespective of who is there.
Thank you very much for your time, and thank you very much for this CNBC exclusive.
Thank you.
And that's a wrap on my exclusive interview with Shaktikanta Das, Governor of the Reserve Bank of India. And Tanvir Gill, thank you so much for watching.
I don't think